Hi everyone, my name is Danielle Glosson and this is my pro forma spreadsheet for the Circle Training Facility. The Circle is basically a facility that is geared towards young female athletes, especially softball players that want to go and play college softball, and just making sure that they're prepared and become a complete athlete, so they're proficient with their skill training, their athletic performance, getting bigger, faster, stronger, nutrition, and their mental game, working with a sports psychologist. So my initial cash balance is $150,000. My units sold. I won't sell anything the first 3 months just because it's the startup phase, but I'll have a cumulative number of units sold at 1,620 at month 12 for year 1, and year 2 I'll be at 6,300. So the product pricing, price per unit is $125, and that's for both years. It doesn't change. The direct cost, it'll be $2 for materials and $25 for the labor for each unit produced. So the number of units manufactured per month are listed here, and I'll be at a cumulative of 1,775 by year 1 and 6,455 by year 2. Inventory, so these are going to be more of just the training booklets because most of my other services will be offered, the instruction will be on demand. So your beginning balance, I'll start with nothing. We'll make 50 products. We won't sell any of them, so the net change is 50, giving us, and all these red numbers usually mean negatives throughout the spreadsheet, but in this case that means that we'll have 50 of those booklets for inventory. It'll kind of slack off right here and be pretty consistent at 155 until month 11, just because I think people will probably want to experiment and see what the training facility really does before they want to buy the booklet that kind of goes with it. So by year 1 I'll have 135 booklets in the inventory, and then by year 2 I'll only have 3. So you'll definitely see that people start buying them after they get, a couple months under their belt. The fixed cost, the rent, salary starts at $60,000 for year 1, and then marketing, the couple months here at $2,000, then it kind of goes off to $500. That's just going to be a bigger push based on what season we're talking about for softball, just to get our name out there a little more. In year 2, you'll notice that rent goes up to $2,200, and then the salary went up to $120,000. So you take that number, divide it by the 12 months, and you'll get $10,000 per month for salary. The cost of equipment, we're just going to have a fixed rate of $48,000, and it'll go through a 3-year depreciation. So you divide that by 36 months and get $1,333 per month for depreciation. So year 1 will have $32,000 that it'll depreciate. Year 2 will be at $16,000. The tax rate is going to be 30%, and then your interest earned on cash is going to be at 3%. So everything kind of comes back to your assumptions page. So your sources and uses of cash, this prior month's ending cash balance comes from the month before, so it's important to get this ending cash balance before you move on to the next month. So to get an ending cash balance, you're going to take your cash available, which is that $150,000 that we started off with, plus your total sources of cash. Those are the product sales, so we had none those first 3 months. And then you're going to subtract your total uses of cash. So materials were at $2 per unit times your number of units that month, and then you're going to add that to your $25 for labor times that number of units per month. Add those together, that's your total direct cost. So the cash from your operations is going to be this total sources of cash, which we had 0, minus your total direct cost. So these 3 numbers are going to be in the negative, in the red. So again, for the ending cash balance, you're going to take $150,000 minus plus your total sources of cash minus your total uses of cash. So this number here, your direct cost, plus your fixed costs, so all the rent, salary, marketing, taxes. And then you're going to subtract that cost of equipment, giving you $91,000. That's going to start off month 2. So my month 12 ending cash balance is $164,000. I'll move that over here to month 13 for year 2, do the same process, and I will get an ending cash balance of $385,000 down here for year 2. So our income statement, the net sales is the number of units per month times that $125 per unit. So again, no sales those first 3 months. The total cost of goods, so this is going to be the sum of your materials and the labor. And so again, that's going to be your $2 times that number of units produced for materials and $25 times the number of units produced that month for the labor. Your gross margin is going to be the net sales, so this starting number up here, minus that total cost of goods. So these 3 are in the red because again, we just didn't have any sales up there. And then the gross margin percentage is going to be that gross margin minus this net sales. So we start off with 0% and then bump up pretty significantly to 78%. All right, the net operating income is that gross margin minus your total operating expenses, which is the rent, salaries, marketing, and then you're also going to subtract that cost of equipment. So again, these are going to be in the red, and then we'll hop back up into the positive numbers. The pre-tax earnings is going to be the net operating income plus your interest on cash at that 3%. That was on our assumptions page. And the net taxable income is going to be your pre-tax earnings minus that depreciation of $1,333. The net income is going to be the net taxable income minus your provision for taxes. And the provision for taxes is going to be your total net taxable in year 2 times your 30% from the assumptions page. So we didn't tax anything until we started making money. So we have a negative here. Will be in month 12 we had $15,000 for net income, but once we added all of our months up, we were actually down $4,000. But then if you look over here in year 2, we've moved into $205,000 for our net income. So the balance sheet, your cash is going to be the ending cash balance from the sources and uses page for year 1, and then your sources and uses, the ending cash balance for year 2. The receivables is going to be your month 12 units sold times your month 12 price per unit. Same thing for year 2. It's going to be the month 24 units sold times your month 24 price per unit. The inventory is going to be your cost of materials and labor per unit times the month 12 post-sales inventory, and this one will just be times the month 24 post-sales inventory. So we talked about how those training booklets really started to get sold in year 2. So we only had like 3 left, I think. So that's why you'll see a big decrease in the inventory. So the total current assets is equal to the sum of the cash, receivables, and the inventory. So all these 3 numbers. Your fixed assets is that $48,000 for the cost of equipment, and then the less accumulated is the $16,000. So by year 2, it was at $32,000. So your net fixed assets is going to be your fixed assets minus that less accumulated depreciation, and your total assets are going to be the total current assets, and you're going to add those net fixed assets to get your total assets of $225,000 in year 1 and $464,000 in year 2. All right, so the liabilities, the accounts payable materials is going to be the month 12 total units times that $2 for the material, and then this will be the month 24 units manufactured times the $2 for material. The accrued salaries, those are going to even out because you assumed that you were going to make $60,000 a year, and then on your sources and uses of cash, you showed that you paid $60,000, and this one was $120,000. So these are just going to be the sum of these two numbers for your total current liabilities. The paid-in capital was at $150,000, and your retained earnings is going to be the total liability and stockholders' equity minus your total current liabilities, and then minus this paid-in capital. So that's going to give you your retained earnings. And for your total equity, it's just going to be the paid-in capital, and you're going to add this retained earnings. So our equity for year 1 was $224,000, year 2 is $463,000, giving us the total liability and stockholders' equity is basically your total assets up here. So going into our revenue assumptions, this kind of breaks it down a little bit more. So for each month here, we've broken down what that $125 per month type thing for your athletes are going to be, the customers per month. So I took this number and I divided it by 4 just to give you the number of customers, because they're going to go through each of these: skill training, athletic performance, the dietitian consultation, and the sports psychologist consultation. So the revenue, to get the revenue here, you're going to multiply the number of items purchased, and you're going to multiply that by this softball skill is $15, but it'll pop up to $25 for a dietitian consultation and a sports psychologist. So for this revenue, you'll get $375, but for this revenue for the dietitian, you'll get $625. And so that just kind of gives you a good breakdown of what each aspect of the business incorporates. So we'll go, that's the product pricing right here. We talked about that. It kind of stays the same throughout all the months. And then your marketing expenses, we talked about how sometimes you need an extra push depending on which month. So you'll see more dollars factored in for a couple months leading up into the school year, and then pushing again right before the summer. So we have a total marketing expense of $6,260, which includes the website, radio, outdoor advertising, signage, print, flyers, and a podcast. And so we can also look at year 2 here, and it's the same thing. We're just going to have more customers because we're expanding and growing the business. So you'll see here I have in 2016-17 we have 2,540 customers total with $50,000 in revenue, and then 2017-18 5,481 customers, and we pretty much double and hit $108,915 in total revenue. But yeah, it's this exercise was definitely enjoyable, and I feel like I learned a lot about my business and pretty excited to get this thing going. But again, most of this stuff goes back to this assumptions page, and those are just all your fixed numbers on what you go off of to use those formulas in your sources and uses of cash, income statement, balance sheet, and even the revenues assumption. So thank you guys for listening to my pro forma screencast on the Circle Training Facility.